Hey everyone, happy Monday. We're going to talk about the mayhem in the markets. This presentation is brought to you by TraderAid.com, by retail, for retail. And I'm Mayhem, navigating you through these charts, talking about what they mean, why they matter, so we have a better understanding as to how they're impacting the economy and markets. The first chart we have here is of CPI, which is still hot. U.S. core inflation rose to levels not seen since 1982 at 6.6% year over year. This is concerning Fed speakers who claim they don't believe they're making a dent in inflation yet. The Minute spoke to this as well, as the Fed felt that they had cause to continue down the path of more aggressive rate hikes, at least in November and December, based on their dot plot. We also see Fed funds futures pricing in a terminal rate as high as 5% for next year and staying at that level for some time. The Fed seems steadfast on their QT runoff of their balance sheet, an up to amount of $95 billion a month to drain that balance sheet at a run rate of approximately $1.1 trillion a year, or up to that amount, is the rate the Fed has accelerated to during September. And we're seeing that through October, while the Treasury continues to issue a pretty sizable amount of debt. Of course, the psychology of inflation is important. If consumers believe inflation is going to become entrenched, they may start changing their buying patterns, especially in the sense of buying more staples than they may need to try to take advantage of prices before they believe they may rise, which can create a feedback loop that makes inflation worse. We did see the University of Michigan consumer sentiment data show inflation expectations were the highest since March of this year, and that retrenchment to a higher level is a concern to observers, because it does suggest that that sort of psychology of trying to buy what you can while it's still lower in price could start to take place if those expectations remain intact. We can see that the weighting of CPI is focused on shelter, 32.39%. In fact, PCE is 20% or close to 20% less than that in its weighting. Nevertheless, CPI is a very important number. It moves markets. It's actually been the econometric that's moved markets the most in 2022. It's important to look at shelter because not only is it a key weighting, but the owner's equivalent rent survey is a lagging indicator that tends to be quite noisy. Essentially, they're asking homeowners, what would you rent your home for? And that survey data, which can be up to 6 months old, is included in the CPI report, and that in turn has an impact, a backward-looking impact, on the number we receive. CPI is a measure of the inflationary velocity of price, and so when data is lagging, it tends to create problems with the accuracy of the data and how meaningful it is within the context of the current economy. Food, energy, and medical care are more real-time. These are, again, largely based on survey results. There is some data sampling that happens as well. And we can see there's more volatility, especially in food and energy, whereas medical costs tend to exceed the rate of inflation, sometimes by as much as twofold or even more. PCE is the Fed's favorite flavor of inflation, so it is more important to watch overall than CPI to get a direction on where monetary policy will be going. But nevertheless, CPI moves markets, so traders and investors should be taking a careful look at not only the headline numbers, but also the deeper down readings that you see month over month to get a sense of momentum, to get a sense of trend. We are seeing financial conditions tighten further. We're now getting back into these levels we haven't seen since the COVID crash. This is because liquidity is being pulled out of the global financial system and the cost of capital is rising at a record pace. And this, in turn, creates more volatility in the bond market. We can see the MOVE index, similar to financial conditions, is at levels now that we haven't seen since the COVID crash, and we'll probably exceed those levels and get back to levels of volatility we haven't seen since the great financial crisis. Why does this matter? Because bond markets are increasingly illiquid. That's driving this volatility, and this same volatility and illiquidity is bleeding into other markets as a result of quantitative tightening, whether we're talking about equity markets, commodity markets. This is a situation that is likely to further worsen as central banks continue to pull liquidity out of the global financial system and increase the cost of capital. We also see that just basing Fed and other central bank balance sheet sizes off of how they move with regards to S&P revenues per share. This is interesting because what it suggests is that during periods of earnings recession, or in this case, revenue recession, which is generally a period where the economy is struggling as well, we see that the Fed responds. This same chart suggests, because we haven't seen significant compression in S&P 500 company revenue, that the Fed is nowhere near a pivot. We'll obviously have to take a look at how quarter 3 does, and those earnings are starting to come down the pipe, so we're getting a better idea. But until we're at the end of this earnings season and we really get to see where revenues are for S&P 500 companies, I don't think we can conclude we're anywhere close to a pivot, and I would doubt that we even see this as a big issue in Q3 earnings. I believe it may not manifest until Q4 or early next year. Nevertheless, this is an interesting chart to look at. It's from Yardini.com. They've got a lot of great free charts there. And I thought that this correlation between the size of central bank balance sheets versus decreasing S&P 500 company revenues was rather telling. Semiconductor estimates are softening. Speaking of fundamentals, we have an increasingly challenging global economy, and semiconductors as a result are seeing downgrades from analysts, and these downgrades are warranted. They're warranted because consumer electronics are seeing a slower and slower refresh cycle. In fact, these downward earnings revisions may not even capture the extent at which semiconductor earnings do fall. So I think it's important to look at that. Semiconductors are a sector that leads both the market and the economy. It is such an important part of the world because everything runs on chips, that when the demand for chips is falling, when earnings are compressing for these companies, it is a sign that we are in broader trouble for the economy and the market. And this year, the 60-40 portfolio died unless something really radical happens before the end of this year. This has been the worst performance for this portfolio configuration in the past century. Inflation has been discouraging many from holding bonds. In fact, it's caused a jettison out of a lot of fixed income. And equities have been in their own bear market in no small part thanks to a hawkish Fed, which has also hurt the bond market. So we have a combination of factors, this globally harmonized deleveraging out of a multitude of different asset classes. And here we can see that both bonds and stocks have been routed this year, neither providing a safe haven. And this has a lot to do with the fact that we are in a completely different environment now. After 3 decades of low inflation to disinflation, we are now experiencing a bout of structural inflation, the likes of which we really haven't seen since the 70s, since the early 80s. And we can see the last time we had anything approaching this type of decline in the 60-40 portfolio was in the 1970s, and before that, not really since the Great Depression. So why is this important? Because it shows you the scale at which wealth destruction is happening for all variety of investors. Whether you're supposedly risk intolerant, which puts people more into bonds, or more risk on, which would put people more into equities, you're going to get hurt this year. In fact, there's not really many assets one could be hiding in this year. And stocks are still not attractive yet. The TINA trade has ended. That is to say, there are alternatives in fixed income for the brave Some, including Goldman Sachs, have suggested that investment-grade corporate debt might provide some interesting opportunities here, as many of these companies are better capitalized and don't have high refinancing requirements in the here and now. That suggests to me that we are going to see more demand in fixed income, particularly in corporate and treasury debt, during a time when equity dividends are not attractive in comparison. And that also tells us that equities themselves are not as attractive. And we can go through multiple different metrics to illustrate that, but I wanted to focus here and now on the delta between fixed income and stocks. Bull and bear markets over the last 90 years, this is always a fun chart to look at, because what it's really telling us is that we are in a situation where we're only in the beginning of a bear market by any reasonable stretch. The average bear market lasts about a year with about a 33% decline. We're about halfway through that in terms of the length of this bear market at best, and we've seen a 25% decline. So we still have more potential downside, and that's if this is an average bear market. It very well could be worse than an average bear market. So this is a time to be cautious for investors and traders. That's at least what I'm doing. Certainly not offering any advice or recommendations, but I do believe that we are in for worse times ahead. We will certainly have violent counter-trend bear market rallies, and those will be the occasions to raise cash and to put on hedges and to even consider shorts. That's what I look at it for. And on the other side of that, we're also going to have more than likely further legs down that make new meaningful lows in the S&P 500 and other equity indices. So I hope this is helpful to everyone that tuned in. If you like this content and you're looking for more fundamental, macro, and technical analysis from a team of experienced traders and investors and industry professionals, visit us at TraderAid.com. You can sign up for as little as $19.99 a month to get access to our website and video content, or for $49.99 a month, you can have all that as well as our Discord server. And because you're tuning in on YouTube, you can get $20 off your first month of TraderAid for the Discord server or TraderAid Plus by entering in the code YouTube Sale.